what is your DTI ratio and why does it matter? Your debt to income ratio, or DTI ratio, is a measure of your total monthly debt obligations in comparison to your gross monthly income. That would be your income before taxes and before any payroll deductions. And your DTI is made up of two separate parts. You have your front end ratio and your back end ratio. Your front end ratio is essentially just your monthly payment for your primary housing expense in comparison to your total monthly gross income. So as an example, if your gross monthly income is $8,000 and your primary housing expense, which if you're purchasing a home is going to be your new mortgage payment, is $3,000, that would give you a front end DTI of 37.5%. You just divide 3,000 into 8,000 and that gives you the ratio or the percentage for your front end DTI. Now, your back end DTI takes that same number, your primary housing expense or your mortgage payment, and on top of that, it adds in anything else that would report on your credit report, like auto loans, student loans, minimum payments on credit cards, personal loans, things like that. So your back end DTI or your back end ratio is your front end ratio plus any other monthly debts that you have. Doesn't include things like groceries, gas, cell phone bills, things like that. Only thing where you are obligated on a monthly repayment for a debt that is actually tied to your credit. Now, different loan programs will have different thresholds for DTI ratios. So for example, if you have good credit, a conventional loan will allow you to carry a DTI ratio of 50 over 50, which basically means your front end DTI ratio can be 50 and your back end DTI ratio can be 50. Or you can have a total debt load of $4,000, and that can be made up entirely of your mortgage payment if you have no other auto loans or student loans or anything like that. So out of your $8,000 a month income, a conventional loan will allow you to carry a total debt load or a back end DTI ratio of 50. For an FHA loan, it's 46.999 on the front end and 56.999 on the back end. For a VA loan, there's actually no hard and fast rule as far as DTI ratios, but it is something that's evaluated in your overall risk profile when it's evaluated by an automated underwriting system. So the specifics aren't necessarily super important, but just know that DTI ratios vary based on your credit score and based on your loan program as far as what's allowable. Now, you may be wondering, why do I care about DTI ratios? How does that matter in the whole home buying process? Well, your DTI matters because it determines how much you qualify for as far as a maximum monthly mortgage payment. Your maximum mortgage payment is what translates into what you qualify for as far as a loan amount, and your loan amount ultimately determines how much you qualify for as far as a sales price, or what price point can you actually shop and buy in. So just know that there may be a time where you talk with a lender and they say, hey, you're qualified for a monthly payment of $4,000 per month. But you're thinking, I really don't feel comfortable going above $3,500 a month, just as an example. I always recommend when I'm talking with my clients, if you're shopping for a home and your lender tells you you're qualified for more, try to start with that lower amount. So stick within the price range that will give you that payment of $3,500 a month, but just keep it in your back pocket to where if you find the absolute perfect home and it would stretch you to that higher end of the maybe $4,000 a month and it's doable, if it checks all the boxes, just know that you have that option available for you. On the flip side, you may talk to a loan officer and they may say, hey, you're only qualified for $700,000, but you really know that you need to get to $750,000 or $800,000 in order to find the home that is suitable for you and for your families, has enough bedrooms, is in the right school district, that type of thing. So there are a few things that you can do to reduce your DTI, which will allow you to qualify for more. One thing you can do is you can increase your down payment. You can add a co-borrower who's supplying more income to the loan. You can discuss with your loan officer if it makes sense to pay points or pay a higher fee in exchange for a lower interest rate. Or something that's super easy is if you have any debts hanging around, that may be easy to pay off, that would eliminate a big burden as far as your monthly budget, that may be something you want to look at. Do you have an auto loan with maybe only a year left on it where you could pay that off at closing and that would free up $500 in your debt to income ratio? Do you have a handful of really small credit cards that are all reporting a $35 a month minimum payment that you could pay off at closing, with a couple $1,000s that would allow you to just kind of get that little extra out of your pre-approval that you would need to get in the price range that you're looking at? And at the end of the day, know that different lenders have different requirements, different overlays, which are essentially different restrictive requirements on top of kind of the basic guidelines that every lender must follow. So you may talk to 3 loan officers and get 3 different pre-approval numbers. So I hope this was helpful, kind of giving an overview of what your DTI is, why it matters, and we'd love to chat with you and answer any questions that you may have. So hope you have a wonderful day. We'd love to help you out. And if you have any questions on this or anything else, feel free to reach out to us. Thanks.